Peter Schiff, CEO at Euro Pacific Capital. He joins us now live out of Connecticut. Peter, always good to talk to you and appreciate the time. So Dow 18,000, we've broken that. Q3 GDP growth 5% for the U.S., and you're still doom and gloom. Why?
Well, yeah, that is a big number, but number one, it's in the rearview mirror, right? That quarter is past. And if you look at all the economic data that has come out for October, November, now we're getting some for December, it is very weak. It's all way below expectations. It suggests that maybe at best Q4 will be in the low twos. It might even have a one handle. So that is a rapid deceleration of that number. And if you actually look beneath the surface, why did we have the 5%? A good portion of it was due to a big build in inventories because businesses are also, believe in this recovery, and so they're stocking up on merchandise that they believe they're going to be able to sell. I think they're going to be disappointed in the holiday sales, and that's not going to bode well for Q1. Meanwhile, there was a big ramp up in healthcare spending.
Yeah, well, we'll get to healthcare and all that kind of stuff in just a bit. I wanted to ask you, though, if businesses believe in the economy and the recovery, and they're, stocking up in terms of inventories, why are you skeptical that final demand is not going to be there when we've got, 8-9 months now in excess of 200,000 jobs, new jobs created every month?
Yeah, 200,000 part-time jobs. These are not really high-paying jobs. A lot of the people who are taking those part-time jobs don't even want them. People in their 60s and 70s who are retired are being forced to take part-time jobs just to pay their electric bills. And then a lot of younger people who need full-time jobs, they have to settle for part-time jobs. So you can't really build an economy on these low-paying part-time jobs.
But it's a start, and it's money in people's pocket nonetheless, and you are seeing consumer spending coming through. You're seeing consumer demand sitting at the strongest level since Q4 2010, and the signals that are coming through from the consumer aspects of the economy, which makes up 2/3 of GDP, are strong. You really do appear to be, Peter, a lone voice in amongst a lot of bulls out there.
Well, I'm used to that. There are a lot of bulls in 1999. There are a lot of bulls in 2007. Look, consumers are not in good shape. The savings rate today came out. It hit a new low for the year. Look at what's happening in the housing market. The numbers have really been abysmal, so that market is rolling over. Remember, this whole recovery is built on a foundation of asset bubbles, and those bubbles will deflate without the Fed. Now, so far, the stock market is defying that. But, I don't know how much longer the rally can go without the Fed's support. And the Fed is pretending that it can raise interest rates without the economy going back into recession. I don't see how that's possible.
All right, well, here's the other option. What if they delay raising rates until, Don Cohen, the former vice chair of the Fed, was talking about this just about a day ago, pushing it out to 2016. Will that buy the economy enough time to recover fully or more strongly?
No, it can't. It's impossible to have a legitimate recovery as long as the Fed is artificially stimulating with quantitative easing. But I believe they are going to delay it indefinitely. Look, if this was a legitimate recovery, if the Federal Reserve actually had confidence in this recovery, they would have raised rates years ago. Or they would just raise them right now. But they can't. All they can do is talk about raising rates. Why don't they just do it? It's because they're afraid of pricking this bubble because it's the biggest one ever.
Well, Peter, we will be checking in with you, definitely, in the new year. But thanks for adding your voice to the debate. Appreciate your time, and a very happy Christmas to you, of course. Well, we're off to a quick break now.
Merry Christmas to you, too.
Thanks. We're off to a